often when you talk about investments and you talk about investment products, the number of options available to you are numerous, and sometimes that leads to what is called the paradox of choice. You're faced with such a multitude of choice that it becomes hard to choose just one or the other product, because each of those products have their own unique principles or features, and you don't know which one is good for you. Now, we want to simplify things. We want to get things back to the basics, so to speak, and we want to talk about the construction of an equity portfolio when you're talking about mutual funds, equity mutual funds. What are the principles that you need to follow? Is it as simple as knowing the rules that govern how much large cap, mid cap, small cap needs to be in your portfolio? Is there a sensible way of going into this before you worry about which mutual fund scheme to buy? That's the topic of conversation today. Joining me to talk about this is Harsh Rumta, founder of Fee Only Investment Advisors. Thank you so much, as always, Harsh, for joining in. And we were discussing this topic before the show, and you said that before we get into the principles of this, the rules of this, there are a few factors that every individual must pay attention to. What are they?
I think first is, get rid of this notion that, selecting the best scheme, and if I just knew how to select the best scheme, my job is done. I think getting rid of that notion is a key thing. I think selecting a scheme comes at the end of a process, and if you follow that process well, it is, it's not that difficult to select a scheme. So I think that's point one. Remember, the most important thing is not scheme selection, it is asset allocation. And asset allocation, it's a technical word, but it's very simple. How much of your investments would you want to put in domestic equity, how much in international equity, how much in gold, how much in real estate? I'm just choosing these four asset classes because for a normal viewer of this program, those are the four that are reasonably easily available and probably are most relevant. So how do you do this asset allocation? How do you decide how much to domestic equity, how much to international equity, how much to gold, how much to real estate? And I think that again is a process, right? It depends on what you are going to be using these investments for. What is your goal? How long, in the future is it? What is this type of goal? Is it time sensitive? A goal like child's education is more or less the time element is sort of, it is linked to the chronological age of the child, and therefore it's more or less fixed as to when that goal will come up, more or less, right? That's one. Second, also the importance of the goal, right? These are some goals that are, most important, and some could be slightly less important. We also spoke of time sensitiveness. There could be goals like, say, buying a house, where it is not fixed as to what you have much more flexibility. The impact of that is that longer your goal, more aggressive can you be, all other things remaining equal. Smaller the lower the tenure of the goal, less aggressive you can be. Importance, more important the goal, less aggressive you can be, other things sort of remaining the same. Risk-taking ability. I think, again, each of us have an inherent risk-taking ability. And obviously, lower your inherent risk-taking ability, less aggressive you have to be and you need to be. And fourth could also be availability of resources. Sometimes your goals and most important goals are that you need to achieve are, quite aggressive in the sense that their value would be very difficult to get to unless you marshal your resources aggressively. Because, high returns can only come from high risk. You cannot get high returns without high risk. And therefore, sometimes your lack of resources can make you take higher risks, move from, say, domestic fixed income to domestic equity, even though your inherent risk taking ability is smaller. So I think the interplay of these four things will really decide how much you will allocate to each of these schemes. And it is on, and then comes key in.
Absolutely.
So, I mean, after that comes, how do you break up domestic equity? And after you determine that breakup, I think comes which schemes to choose in that, whatever you have decided.
Yes. Just to sum up what you've said, these 4 points, I'm going to repeat them for the benefit of our viewers. You've spoken about the importance of a goal, what that goal is. Is it a very important goal that is not something that you can shift? It's not a shifting goalpost. You have to achieve it within a particular amount of time. The second one is your risk-taking ability or tolerance level. The third one is the tenure of the goal. How far away is this goal? Is it more than 5 years away? If so, you can afford to take a riskier asset like equity. And finally, the availability of resources. Do you have enough money to put into these instruments? If you don't, then perhaps you have to take more risk. All right, so you've explained this very, very simply and very well, Harsh. And interestingly, each person that is viewing this show can put themselves into certain baskets based on where each of them fit, right? So if they have the goal of buying a house, say, if they don't have a very high risk taking capability, if they have resources available, they can apportion a certain amount of money and they plan to do this in 10 years time, then they have a set of criteria that they need to follow as well. But let's take a few examples. Let's first talk about an individual that has very low risk taking capability. How does that person go about setting up a mutual fund equity portfolio?
So I think even a person with very low inherent risk-taking abilities, for goals that are medium term, and by medium term I mean say 5 years and higher, or long term, and that would mean say 10 years and higher, there should be some equity component, some domestic equity component to that, because the reason for that is that over such periods, to be able to earn returns that are in excess of inflation, after tax that too, you would need certain component that will give you a higher than inflation return. And then that can pull up your overall return. So even for people with low inherent risk-taking ability, for medium term and long term, there has to be some allocation to domestic equity. But in their case, I mean, my suggestion would be that they can choose domestic equity, but cut out all other kind of risks, and simply choose a passive fund. That passive fund could be a large cap like a Nifty 50 or a Nifty 100. It could even be a multi cap like a Nifty 500. Okay. But basically stick to passive, and don't get into this core and satellite for a person with very low inherent risk taking abilities.
Okay, so you mentioned core and satellite, and this is something that we've spoken about often on this program, Harsh. It's essentially where you have the foundation or the heart of your portfolio that is rock solid generally, and you have a peripheral allocation towards something that is riskier. That is because you want your core to be something that is more able to give you an expected return, and you have the peripheral or the satellite part of your portfolio which can potentially give you much more than the return that you're expecting from your core. That's how you would explain it. And would you say that this is something that the person with a medium to high risk taking capability can follow?
So I would slightly differ there. I would say a core portfolio, I would hesitate to describe it as rock solid, because end of the day, it's equity, right? It has its inherent risk. The job of the core portfolio is to earn what the index earns broadly. You're not trying to seek more than the benchmark returns in your core portfolio. It is in the satellite portfolio that you take sort of higher risks in your quest for higher returns. I think that is the way I would describe. So coming back to somebody with a medium to high risk taking abilities, when they are doing medium to long tenure goals, obviously their domestic equity component will be higher than what a person with a low risk taking ability would have. And even this higher uh, domestic equity component can now be broken up into core and satellite, where say, I mean, again, it will be very dependent on the type of goal, tenure, risk-taking ability, but say 40, 60, maybe even 80, because risk-taking ability is a continuum. It's not really discrete numbers, right? So, I mean, anywhere between 40 to 80% of that portfolio should be passive. And for the balance, okay, whatever you would call satellite, you can go in for a higher risk, and that can be a mid cap fund. It can be an actively managed mid cap fund. It can be an actively managed small cap fund. Actively managed flexi-cap fund. Flexi-cap fund, by definition, should logically be actively managed. So I think that is something that you can look at for the satellite portion. In fact, for the satellite portion, if it is large enough, that satellite portion, you could also look for portfolio management schemes that work in the particular capitalizations or the type of risk that you want to take. For that, of course, the overall size would have to be large. Therefore, domestic equity allocation would be large, and therefore satellite would be large enough to be able to do portfolio management scheme, which is a minimum of 50 lakhs. But that's where, in the satellite is where the PMS would fit in. Incidentally, a very good way of doing these allocations also could be the self-balancing type of excuse me, the self-balancing type of funds, like a balancing fund, a balanced fund, or a balanced advantage kind of a fund. Or now, in fact, you have funds that mix all four: domestic equity, international equity, gold. I haven't seen a real estate, but at least these three I've seen it getting mixed. The beauty of that is the self-balancing nature. So if it matches your allocation, then at least within it, it keeps self-balancing. And that also is a pretty good way of taking exposure to these particular asset classes.
So the way that you've spoken about this, Harsh, and to tie it to the parameters that you spoke about right at the start, you've said anywhere between 40 to 80% of an individual's equity portfolio has to be or should ideally be their core. And this core, because it is something that should track the return on the index, you might as well buy the index in the form of passives. So you've already made an individual's job that much easier. They don't have to worry about the whole of their portfolio. Already between 40 and 80% they can allocate towards one simple fund or scheme. It can either be a 50 Nifty 50, or it can be 100, or it can in fact be the entire Nifty 5, the 500 stocks that are available. So you made things a little easier to understand. Now, what I'm trying to get at next is the remainder. You've said that there are various options available, and this is where people will get a little bit confused. Is it more important to be consistent and to say, suppose I have 15,000 or 20,000 rupees available to me to invest every month, I continue to invest it in the ratio that has been determined, Is it more important to stay consistent rather than choosing the right scheme?
Oh, absolutely. I think if you were to choose between consistency and the ability to pick winners, okay, over the long term, 8 to 10. I mean, and this data has shown, okay, I have not done this, but this data is available out there, that if somebody did investments for 10 years by looking at last year's winner and investing in it this year, versus somebody who picked up, say, this year's winner and stayed with it for 10 years, the person who stayed with that winner, okay, typically has done better than somebody who invested in last year's winners. That's because winners rotate. And the fund that was done well last year will not do well this year, may again do well 3 years down the line. Over 10 years it tends to do well, because it was a winner at some point of time, and it has intermittently been winners. Over a long time it tends to do quite well. So consistency is extremely important. Just one caveat there, that you need to do some rebalancing, and even that needs to be fixed in advance. So whatever rebalancing you decide to do, fix the periodicity, that I will do it 6 monthly. I think once a year periodicity is absolutely fine. You can overdo rebalancing. So I think once a year is fine. You also define cutoffs beyond which you will do a sooner rebalancing. So suppose the market goes up 20%, you need to decide that in advance. Do not depend on your reading of the situation. If you have defined rules in advance, then doing even in between periods rebalancing is fine, provided you are consistently following a rule. So I think consistency is the word that you have used.
Absolutely.
I think that is the most important component of success in achieving your goals and making the right investments to achieve those goals.
Absolutely. Harsh, thank you so much for joining in. I hope that our conversation has simplified things for people joining in and viewing this program, and they'll thank you, I'm sure, as I am thanking you. Thank you so much for taking the time.
Thank you, Alex.
All right, that brings us to the end of this conversation, but there's more lined up on the show. Do stay tuned. We're heading into a short commercial break.